All right, Tyler,
All right.
we've got some palace intrigue going on at PayPal.
Look, there's a lot to discuss here at PayPal, but when your CEO of less than 3 years is unceremoniously thrown out the door, there was something going on in the background.
Yeah, there's no doubt about that. We're going to talk about PayPal's new CEO replacing the CEO that most everybody else thought was doing okay. And more importantly, taking a look at the business and whether we think this is an opportunity or a stock to avoid. I'm Jason Hall. That's Tyler Crow. This is Investing Unscripted. Before we get into the details here, just a reminder, this video is sponsored by The Motley Fool. We get to make these videos because of that great partnership. And we have an opportunity for you to upsize your investing, upskill yourself. Go to our special link. It's fool.com/unscripted. Go to that link and you can get access to the Motley Fool's 10 best stocks to buy right now. You can help yourself out and you can help us continue to make great content that hopefully you enjoy and get something out of. Okay, Tyler, I'm going to start with the results. Just as far as I'm concerned, the results were pretty much on track with what investors were expecting. Revenue was up a decent amount. It was growing at low to mid single digits. Transaction margins have been okay. There are a few things that are a little bit concerning. We continue to see relatively weak transaction margin. That's something that investors have been wanting to see expand. And we're seeing a decrease in transactions per active account, 5% in the quarter and in the year. So some decent signs that things are still moving ahead of pace, but also some concerns with the business. Like one thing that we know is that there's this expectation that the company would start growing more of its branded payments where it has margin, where it should be able to have some brand equity to create value. But instead, it seems like it's been leaning into more like the white label payments business that it does, which is a knife fight. And it's less sticky with the customers, the corporate customers that are using it for payments, that they can change payments providers relatively easily. And it comes down to the price in most cases. There's just not a lot of differentiation. But again, we thought the business was moving forward mostly based on Alex Chris's plan, but out of nowhere, what happened?
We haven't really gotten like the confessional or business reporter that's been able to go behind the scenes at PayPal, but basically we got an announcement earlier this week that PayPal had announced a new CEO, and there wasn't really any discussion of Alex Chris. As far as I can tell, I mean, maybe there's some deep industry publications that we have not been reading, but there hasn't been any strong signals that Alex Chris's job was on the line here. But come around this week and earnings results are out, and apparently Alex Chris is out as well, brought in and replaced with the former CEO at HP, formerly Hewlett Packard.
Yeah, a couple of things that are surprising to me. Number one, it seems like it happened really quickly. And Enrique Lores, who's now the incoming CEO, this was just as big of a shock to the folks at HP, where he was the CEO. HP stock fell once the announcement came out because I don't think those investors were expecting to lose him as CEO. And PayPal's stock fell a massive amount after the announcement came out. And it seems like entirely on this sudden change in leadership. Now, I want to be careful how I say this. I don't want to bury Enrique Lores, who I think has done a fine job at HP. But if you look at the financial results, part of it is the timing with the market. It hasn't been a great time to be selling PCs, but it seems like they maybe have sort of missed some of the opportunity there with the advent of AI to be a player in that space. And if you look at his tenure of about 7 years, roughly his tenure of about 7 years as CEO, he's been in the business for a lot longer than that, but his tenure as CEO of the business, revenue is roughly flat from when he took over again, it's 2018. It's up a little bit, but operating income and cash flows have fallen by double-digit amounts. The stock is roughly flat, and you factor in dividends and dividend growth, and you're looking at about 4% annualized returns, 4.5% annualized returns over a period that the stock market's been going gangbusters more than 15% a year. So you have somebody from commoditized hardware, tech hardware, coming in to run a payments business that's trying to win through differentiation. I have some serious issues with that marriage being one that's going to change a business that's never leveraged the differentiation that it has in a way to create value and grow cash flow per share.
Yeah. One thing to keep in mind too is that Lores was on the board at PayPal.
Oh, for like 5 years.
Yeah. So this isn't completely out of the blue. board chair for a while. If we look at the results, and the press release basically said, like, look, we've seen some progress in some places, but we think the overall execution of this business has not been up to our expectations. And to bring in somebody who was a board member, this being a very, very quiet thing, and then unceremoniously shown the door. And we saw the stock price reaction when PayPal released its earnings. It was not good. And to me, look, there's a lot of things going on here. Maybe Chris wasn't the right person. Maybe there is some path forward with PayPal being a hyper growth business. But let's be honest, that payment and like this payment platform space is getting intensely competitive. And fighting for market share is getting harder and harder by the day. Back when PayPal was like the only alternative payment to like credit cards and banks and stuff like that, it looked great. But now when you're competing against five other payment platforms, whether it be Cash App or they own Venmo, the idea of there's so many others out there available. You have Zelle, you start getting into payments through crypto and stable coins and a lot of these other fintech platforms that are trying to debank. And then you also got just the regular banks trying to maintain margin, all of which still seem to be serving the masters of MasterCard and Visa anyways. There's just the gains that you can get in this industry are just going to get harder and harder by the day. And part of me does genuinely wonder, is this a business that for the longest time, all of its investors thought it was a growth business, when now it just may not necessarily be the case anymore. Maybe it is a slow growth, free cash flow throwing off business. And certainly its valuation seems much more reflective of that reality today than the hyper growth business that we saw in like 2020, 2021.
Yeah, I think that's right. And I want to just add a couple of points here that I think are important. My biggest concern, as much as I don't love this abrupt change in leadership, my biggest concern is thinking about products like in financial services. Usually you look for stickiness, insurance companies, banks, things that are hard for customers to leave. It's the work to leave and find a replacement usually isn't worth going through the effort. But things like Venmo and PayPal, I just don't believe that they haven't proven to be very sticky. Venmo's popular because it's popular. That network effect, though, I think can be really, really leaky. If I want to go to Cash App, it's 5 minutes if I don't have an account, and I have an account, right? It's so easy to make those changes. So I think that lack of stickiness is a real risk. I want to give Enrique Lores one piece of credit here where he could be valuable. We've seen PayPal struggle to create value and create margin and differentiate. Maybe you just need a CEO that's run a tough, grindy, highly competitive commodity business to come in and just let this be a commodity thing, be efficient and make money around the margins and ride the tailwinds of growth of the category and not try to be a differentiator and continue to fail. I'm going to give him some credit. Maybe that's how they win. The valuation, you do have some margin of safety there, but I don't think investors should necessarily expect this to be $100 stock again anytime soon.